All right, welcome to the Explainer. The U.S. housing market. I mean, it's this massive, complicated machine, right? So today, we're going to pop the hood and take a look at one of its most critical parts, Fannie Mae and their latest earnings report. So, how do we really check the health of the housing market's foundation? Well, we're not going to get bogged down with the usual stuff like listings or interest rates. Nope. We're going a level deeper, looking at the financial vital signs of a company that's right at the heart of it all. And that company is Fannie Mae. Yep, their performance gives us this incredible snapshot of the entire system. So we're going to dive into their latest quarterly report to see what it really tells us about the stability of housing in America. Okay, so before we get into the nitty-gritty numbers, let's zoom out. First things first, what is Fannie Mae? And really, why should we care so much about this one company's performance? Well, you can think of them as kind of the ultimate facilitator for the mortgage market. They're a government-sponsored enterprise, which basically means their job is to keep a steady supply of money or liquidity flowing. They're not going to be the ones handing you a loan at the closing table. Instead, they buy mortgages from lenders, which frees up cash so those lenders can turn around and give out more loans. See how that works? And the first thing you have to wrap your head around is just the incredible scale we're talking about here. $4.1 trillion. That's the size of their guarantee book. Basically, it's the total value of mortgages they backstop. It's this giant financial safety net, and it's an absolutely astronomical number that props up a huge chunk of the housing market. And this chart, it really drives home just how big their footprint is. They support about a quarter of all single-family mortgages, for regular homes, and over a fifth of multifamily mortgages for things like apartment buildings. They are, quite literally, everywhere. And all of this financial machinery isn't just numbers on a page. It has a massive real-world impact. We're talking 401,000. That's how many households they helped in just the last 3 months, whether it was buying a home, refinancing, or renting a place. That's a huge number of people. Okay, so that's the big picture. Now let's zoom in and look at the actual scorecard. How did this giant actually perform, financially speaking, in the third quarter of 2025? First up, net income. $3.9 billion. That's their profit for the quarter after all the bills are paid. It's a really strong number and a clear sign that the company is on very solid financial footing. And check this out, $105.5 billion. That's their net worth. And the important thing is, it's been steadily climbing. You want to see that. It's like they're building a bigger and bigger financial cushion, which means more stability for the entire system they support. Now, this table really puts it all into context, right? You can see how Q3 stacks up against Q2, and look, we're seeing healthy, positive growth pretty much across the board. But that 16% jump in net income, that's especially strong. It shows some real momentum. So, where is all this money coming from? To figure that out, we need to pop the hood again and look at the company's two main business engines. It's pretty straightforward, really. On one side, you've got this single-family business. That's all about mortgages for individual homes. And on the other side, you have the multifamily business, which handles loans for big apartment buildings. So one for buying, one for renting. Okay, so the single-family business, this is the absolute powerhouse. It's the biggest segment by far, with a nearly $3.6 trillion guarantee book. It brought in most of the income this quarter, $3.1 billion. But here's the part I find really interesting. 51% of the home purchases they supported were for first-time homebuyers. That's huge for making the market accessible. Now, don't sleep on the multifamily business. Yeah, it's smaller, but it is a standout performer. It generated a healthy $774 million in net income. And get this, that income jumped 33% from the last quarter. A 33% jump. That shows some incredibly strong growth and points to a really healthy rental market. All right, so profits are up. Things are looking good. But profitability is only half the story, isn't it? The real question when we're talking about stability is all about risk. Just how safe are these trillions of dollars in loans that Fannie Mae is backing? Well, this chart gives us a pretty clear answer. And honestly, the picture is incredibly reassuring. That tiny little sliver, 0.46%, represents the seriously delinquent loans. We're talking people who are more than 90 days behind on their payments. So that means the other 99.5% are current. The vast majority of folks are paying their mortgage on time. And you don't have to just take my word for it. The company's own summary says it all. The credit performance of the total guarantee book is relatively stable. They're telling us this isn't some volatile, high-risk portfolio. It's a steady, reliable foundation. Okay, so we've looked at the profits, we've checked the risk gauges. Let's zoom back out and connect all the dots. What's the big takeaway here? What does all this actually mean for the housing market as a whole? Here's the bottom line. A profitable and stable Fannie Mae means a more predictable and liquid mortgage market for everyone. It's really that simple. When they're financially healthy, the whole system benefits. Lenders have cash to lend, and that creates stability and predictability for buyers, sellers, and renters. It's the bedrock. So, Fannie Mae's foundation looks really solid, but of course, it doesn't exist in a vacuum. The report itself brings up potential external pressures, things like the broader economy, climate events, you name it. So while the internal health check gets a big thumbs up, the big question is, what challenges from the outside are going to test that foundation next?